This is part 2 of analyzing and valuing stocks. What I want to go over here is a few external things that impact the value of a stock, as well as a few fundamental concepts of valuing stocks as well, to find out if they're actually valued the right way and if they're worth being invested in. With that being said, let's get started. The first thing I want to talk about is economic impacts on stocks. Economic growth is a measure of a country's financial well-being over a particular period. In the US, we measure the growth by an amount of production, which is referred to as GDP. GDP is the total market value of all things produced within a country. When production is high, it results in more jobs, resulting in more aggregate demand, which means more money is being spent and saved in businesses to further increase revenues for businesses. Again, revenue and profitability for businesses means that a company's working to its fuller potential, so it's more likely to be invested in. Fiscal policy. It's a government policy that imposes taxes on individuals or corporations. When a corporate taxes are being increased, after-tax earnings are decreased, resulting in less money for shareholders. So if you're investing in a company and taxes have been imposed on this corporation and on your personal taxes, you're going to have less money left over when you're receiving dividends or returns on your investments. When taxes are imposed on individuals, they have less money to save. So the consumer is usually consuming less, which is reducing the firm's earnings, which means that there's less money for the shareholders again. So again, if you're a shareholder and taxes are being imposed on individuals who are now spending less at the companies that you're investing in, there's going to be less money for you long term. Another impactor of the value of a company are interest rates. When interest rates are low, firms can retain financing for much cheaper, resulting in a willingness to expand operations. Interest rates are controlled by the Federal Reserve in what we call monetary policy. Consumers can also receive loans for cheaper to buy homes, cars, and so forth for much cheaper because the interest rates are lower. In another course, we're going to talk about interest rates in the Federal Reserve and monetary policy. Right now, the Federal Reserve has a monetary policy where interest rates are 0%. So banks are getting interest for very low, which means that they're lending to other companies for a lot lower. There are schools of thoughts that think that this is wrong for many reasons, mainly because it's giving a false indicator of how well the economy is doing right now. I'm not going to go into too much detail in that right now. This is an introductory course, so I'm not going to try to confuse any of you, and we're going to go back to that in later courses. Inflation is another thing that impacts. Inflation impacts a lot of things, but inflation is the general level of prices of products over a given period of time. The Federal Reserve can control inflation, and it's used to combat unemployment typically. Inflation can be measured by the Consumer Price Index, which measures the prices of goods, consumer products like groceries, household products, gasoline. A firm's prices can also be affected by what's going on in its particular industry. If an industry is doing well as a whole or doing poorly as a whole, this could ultimately impact how well a company is doing. If you know if an industry as a whole is doing poorly because of economic conditions or whatever the case may be, it would be a good idea not to invest in that particular industry at that time. The way of understanding how well an industry is doing is by going to a couple of sources such as Standard & Poor's Industry Survey or Bloomberg.com. Even Yahoo.com gives you industry indexes to show you how well an industry is doing at a particular time. The next couple of slides, or the next 2 slides, I'm going to go over a couple of analysis on valuing stocks. The first one I want to talk about is technical analysis, which is the valuation of a stock based on historical pricing. Meaning, if you're looking at the past year or 6 months of performance of that particular stock, and you see the pricing of that particular stock over that period of time that you're looking at, and the stock's more valued or less valued at that particular time, you can determine whether or not it's worth investing in that particular stock. Another concept is fundamental analysis, which is the valuation of stocks based on the analysis, the impact that economic and industry conditions have on that stock, as well as examining revenue and earnings. So if a company is doing poorly because of some economic conditions, or economic conditions really affect a particular industry or a particular firm, and or industry changes really affect that company, and the company or the industry is doing poorly, obviously you don't want to invest in that stock at the time. Another way of valuing stocks is using the price revenue method, which is simply multiplying the revenue per share times the mean industry average. There's a couple of steps that you take to figuring this out. The first step is to find the price revenue ratio, which is simply the share price, the average share price in the industry divided by the average revenue per share in the industry. We're going to use an example of the average share price being $60 and the average revenue per share being $30. So 60 divided by 30 is 2. So the price revenue ratio in this particular example is 2. The company that you want to invest in has an expected earnings per share of $31. So to find the value of that stock, you would multiply that $31, which is the expected earnings per share, times the price revenue ratio, which in this equation is 2. You multiply those numbers and you're going to get $62. So the value of that stock should be $62 per share. If that company's share price is currently valued at the industry average, which was $60, you can assume that the stock price will go up to about $62. So you're really getting a good deal. So the potential right here of earnings would be $2 per share because of that difference in what it's currently valued at and what it should be valued at. This is the end of part 2 of valuing and analyzing stocks. In the next couple of videos, we're going to go into investing in stocks, investing in bonds, and investing in mutual funds in a little more detail than we did in the introduction to investing and in this particular video on valuing stocks.